Over the past 12 months, bond markets have been nothing short of chaotic. Yields shot up, markets panicked, then cooled off, and now we're more or less back to where we started. But the landscape has changed. The Fed's expected to cut rates next week, and it's pretty much been priced in like it's already happened. So today, we're unpacking what that means for income investors, especially those hunting for dividend yields in this new and frankly confusing environment. We'll break down the macro story, the risks, the traps, and most importantly, how to spot high-quality dividend stocks using our tools. If you'd like to read the full article with charts, data, and deeper analysis, the link is in the description. Now, let's get into it. If you've been watching the bond market this past year, you've probably felt like you were riding a roller coaster blindfolded. While the inflation bonanza of 2022 to 2023 may be behind us, the drama hasn't stopped. Case in point, just as the Fed began talking about rate cuts, bond yields did just the opposite. Since late 2024, the Fed has been on pause, but traders are betting that the cutting cycle officially resumes next week. At the core of bond yield movements are three forces: supply and demand, central bank policy, and perceived risk. And we've seen all three flexing over the past year. Just look at US 10-year Treasury yields. They've been ping-ponging between inflation fears and recession bets. When Trump won the election, markets braced for inflation again. Then came doubts. Then came Liberation Day tariffs. Then more doubts. And now, yields have fallen back to where they were pre-tariffs, at least on the 10-year. The 30-year, on the other hand, is still elevated. That shows how split the market is about the long-term outlook. In the short term, inflation fears are cooling, but the longer term, there's still the elephant in the room, which is the US government's ballooning debt. In fact, around 31% of all publicly held US debt will need to be refinanced within the next 12 months, which is roughly $10 trillion worth. Servicing that is already consuming 22% of federal tax revenue, double what it was just a few years ago. So yes, the Fed has a good reason to push rates lower. But investors aren't buying long-term debt without demanding some serious compensation for the risk they feel they're taking. So let's zoom out for a second and check in on global bond yields. In Europe, the picture is mixed. Germany's stimulus pushed yields higher. UK gilt yields are at a 15-year high as the Bank of England wrestles with inflation. And as for Italy, it's still elevated even after a surprise credit rating upgrade from S&P. Over in Japan, things are finally moving. The Bank of Japan has started easing off its yield curve control, which means Japanese government bond yields are inching higher, but they're still ultra low by global standards. In emerging markets, it's still a split screen. Brazil and other commodity-heavy nations are feeling the pinch from US tariffs and fiscal strain. Meanwhile, Asia's seeing lower yields thanks to easing in China and Thailand. And foreign investors piled into Asian bonds earlier this year, especially between March and May, though that flow has slowed more recently. So globally, the message is the same. Yields are being pulled in all directions, and rate expectations are shifting pretty fast. All of this makes life tricky for income-focused investors. When US Treasuries are yielding 4 to 5%, suddenly the dividend-paying stocks don't look quite as attractive unless they've got something special going on. Utilities have surged with rising electricity demand. The weaker USD has helped some blue-chip names, and a few high-yield outliers in hyped-up sectors have managed to shine. But the usual suspects, like energy, real estate, healthcare, consumer staples, they haven't delivered as expected. Going forward, the big unknowns are the US employment numbers and the Supreme Court's ruling on Trump's tariffs. Both of those catalysts are going to shape rate expectations in a big way. Which brings us to a key point. You need to know your goal. Are you chasing short-term yield or building a long-term income portfolio? Because those are two very different games. So here's how to spot high-quality dividend stocks. Right now, our US high-yield stock screener shows 137 companies offering dividend yields over 10%. But the question is, are those yields sustainable? Big dividend yields can be a red flag. Some companies pay out more than they can afford just to keep yield-hungry investors happy. And when the cash runs dry, the share price often collapses, wiping out years of payouts in an instant. If you're playing the long game, the focus needs to be on quality and sustainability. Here's how we break it down. Firstly, there's cash cows. These are mature companies generating more cash than they can reinvest. Think Coca-Cola. Then there's dividend growth stocks. Companies that can increase payouts over time, like MasterCard and Visa in their early days. And lastly, there's capital and yield combos. This is the holy grail: rising stock prices and rising income. Apple in 2016, for example, yielded 2.4% back then. If you held on, you're now earning 4.4% on your original investment, and the stock is up more than eightfold since then. To find these companies, you need both quantitative and qualitative filters. Our Simply Wall Street Stock Screener is a great starting point. Here's what to look for: profitability metrics like return on equity, return on assets, and margins; growth potential or a defendable profit base if growth has slowed; strong balance sheets with minimal debt and no borrowing to fund dividends; sensible payout ratios, ideally under 40%, though it can vary by sector; and dividend consistency. Has the company raised payouts consistently over time? If that feels like quite a high bar to pass, don't worry, we've built a screener using these exact filters, and as of right now, only 4 stocks in the US make the cut. If you check out the article, you can find out which ones they are. Then comes the qualitative layer. Does the company have a moat? Looking at these quantitative and qualitative measures is how you can find the next Apple and avoid falling for a yield trap. So what's the insight here? In uncertain times, diversify accordingly. There's a lot riding on the upcoming economic data and that Supreme Court decision on tariffs. If tariffs get curtailed, markets may breathe a sign of relief. But if Trump gets the green light to expand them further, it could unleash more volatility. That's why now's not the time to concentrate your bets in one sector. Here are a few dividend-friendly sectors worth watching. Firstly, banks. A steeper yield curve could boost their margins. Oil and gas, because oversupply now might lead to tighter production later on. Utilities, where steady demand and a potential inflation hedge is their friend. And government-backed sectors. Anything with policy tailwinds deserves a closer look. But here's the bottom line. You don't have to chase every high-yield opportunity. If nothing looks right, it's okay to just wait. In the meantime, even short-term bond ETFs like Vanguard's short-term Treasury ETF are yielding over 4%. That and other short-term Treasury ETFs are a solid place to park cash while you wait for better entry points on high-quality dividend names. If you want to dig into the data or explore the dividend screeners we mentioned earlier, check out the full article, links to it in the description. And we'd love to hear from you. So if you have any feedback or suggestions, please let us know in the comments. And we'll be back next week with more market insights. Until then, invest well.